Bud Bugatch joins us from St. Petersburg, Florida. He's an analyst at Raymond James with 25 years of experience on the sell side. Bud also used to be a retailing CEO himself. He rates Wal-Mart strong buy. So he was just walking us through some of the numbers. Bud, you're familiar with them. $1.09 on the earnings per share, $109 billion, both ahead of estimates. Is this the turnaround that investors have been waiting for? Because perhaps most importantly, we saw same-store sales in the United States come in well ahead of expectations.
Well, we're seeing same-store sales actually improve month over month for Walmart during the quarter. They came in at a negative 0.9% for Walmart U.S., and that's better than last quarter. But still not as good as we were looking for, a negative 0.5, but that's a relatively small difference. They are improving. They're not improving at a speed that everybody would like, and the guidance for the third quarter is negative 1 to positive 1 for Walmart U.S. Sam's is where they've had a great deal of success. They were up 5% on a same-store basis without fuel. And those comps get a little more challenging as you go through the second half, but they've had a terrific performance now for several straight quarters.
But if the sales performance isn't as good as you would like to see it, and perhaps other investors as well, how is Walmart milking extra earnings out of this revenue? The stock is trading up right now. The company issued some guidance for the third quarter that, at least on the top end, is more optimistic, and raised its full-year guidance, so something positive must be happening on the margin front.
Well, they are leveraging expenses. They are committed to leveraging expenses. Milking is not exactly the verb I would use, but they are improving their profitability. That's been a focus of Walmart now for several years, and they've been able to do that and deliver on that promise of expense leverage.
Well, if they have been doing it, if they have been executing on one of the most important parts of their business, margin management, why are people so down on the stock? The stock's down 7.4% this year. Consumer staples in the S&P 500 are up. And you know as well as I do that Walmart's performance, since the stock reached a peak of more than $62 back in 2008 has been nothing short of dismal.
Well, that's exactly right, and that's one of the reasons we do have a strong buy. I think Walmart's an awfully good value in stock, as a stock. You know, this is the best retailer in the world. Let's not forget that. They do deliver tremendous sales, and they do deliver excellent earnings and tremendous cash flow, and they're returning a lot of that cash flow to investors as well. So I think that the market just has to accommodate those factors. The dividend yield is pretty impressive in Walmart, certainly at this price. I think that the market will ultimately accord Walmart a much better valuation.
When it comes to any stock in any sector, Bud, investors face choices. What does it say to you that Warren Buffett, instead of perhaps choosing Walmart, which you think is a good value, invested in Dollar General instead?
Well, he increased his investment in Dollar General this quarter, if I read the news properly. I think that it just says that those stores are also fulfilling a need for consumers as well. Consumers do have choices. Walmart has not been happy with what they call its price gap over the last several quarters and years now, and they're improving on that. And we do measure that actually monthly in a grocery survey, pricing survey we do, and they still have a lead over much of their competition, but it is a fragile lead in certain areas. So Walmart is working on that particular aspect of their business. Their health and grocery did do well in this quarter. Hardlines seem to be improving. They were silent, at least in the release, on Softline's performance.
Well, it is a competitive business and a fragile economy, as you point out. Bud Bugatch, thank you. He's a managing director at Raymond James.